Hi, welcome to ACI's first half update for process portfolios. I'm DAC Hearts. I'm the Director of Investment, Chief Market Strategist at ACI. If you'd like to learn more about me, you can visit dachartsock.com/about. I'm going to jump right into this in the interest of saving your time. If you would like to read every word I've got on here and really understand everything rather than me just hitting the highlights, you can press pause on your video player. For my clients that like to spend only a couple of minutes on this sort of thing, you can look at this slide and a couple more slides that show results, and then I would encourage you to skip to the end of the video or towards the end and get the second half outlook. So just to hit a couple of quick highlights here, the portfolios are doing okay. Two of them are doing really well. That's market income and full cycle. We were doing all right in durable opportunities, made a buy in Apple, and I think that's creating a little more volatility and maybe holding the portfolio back a little bit. That's not something that bothers me at all. One of the reasons it doesn't bother me at all is because I found out after the fact that Buffett, or at least Berkshire, was buying Apple at the same time, and in some cases they paid more than I did. So I don't feel too bad about that buy, despite the fact it's a lag right now. Have some other buys coming up that may add some volatility to the portfolio as well, but that I also feel very strongly about are going to deliver long-term value. So I'll let you read through the core equity blurbs here. Not much has changed since the beginning of the year. In terms of changes in core equity performance, it's still lagging. I've got an illustration of why I think that doesn't really matter coming up a little bit farther on in the presentation. And what is important is the recession probability indicator at this point is still forecasting economic growth in the U.S. For those of you that watch these videos or read my articles, you know that this is a very impactful indicator. It's something to pay attention to, whether that means staying invested or pulling back and reducing your risk. So at this point, it says things are okay. That is subject to change, of course. Let's move on. Here's a quick survey of the different asset classes. I'm not going to go through all of these. What I do want to point out is if you look at gold and treasuries, you're seeing really an incredible year. And you know, I've had a couple conversations about, well, should we buy some gold? I just like to point out that it's never a good idea, or very rarely a good idea rather, to chase something higher. And in this case, gold has run up, you know, considerably since the beginning of the year, and it did the same thing in the fourth quarter last year. We saw similar behavior in gold during the last couple of inflection points in the market in 2011, 2012. And what's missed about that story is once people realized the world wasn't going to end, gold plummeted. So if you had bought gold ahead of the 2011 U.S. debt crisis, you would have seen it run up. I think it was about 18%, and then since then it's lost 42%. So a little gold can make sense. We actually have some of it in the full cycle portfolio, but chasing a move up like this rarely works. Here's the other thing that's going on is when you see bonds turn in this kind of performance, what that's saying is there is a tremendous amount of fear in the market, and you don't want to make decisions from a position of fear. So that's why I'm not chasing this move. That's why, you know, we're staying mostly invested. We do have a lot of cash, about 18% on average across all client accounts that we want to put to work when some of this fear spikes in the market. Thought we were going to get that opportunity a week or two ago with the Brexit, and so far it hasn't actually materialized. But we'll see what, you know, the next weeks and months bring. But at any rate, this is a very unusual situation to see this kind of performance in bonds versus this kind of performance in stocks. It's historically an aberration, so we'll see how this plays out. Here's a quick summary of the performance. As you can see, the only model that we've got that is not performing positively is core equity. I'll deal a little bit more with that in the next couple of slides, but not overly disturbed by this at all. Market income is beating the benchmark, which is nice to see. It's also beating the market, and that's kind of what it did last year, so it's just kind of plugging along, doing what it's supposed to do. Full cycle is having a very strong first half of the year. This is a risk parity portfolio that's designed to kind of prosper a little bit in almost all economic environments. It's both beating the model and the benchmark, and that's nice to see. Durable opportunities doing okay, being held back a little by Apple, I think. But not bad. Market momentum is beating its benchmark, which again is great to see. This is a portfolio that if we get some stabilization in the market and it either holds neutral or begins to move steadily up over time, should beat the market. It cannot keep up with a very strong bull market, but it is built to outperform market income in mildly rising markets or neutral markets, which in theory is what we should be facing over the next couple of years, barring a recession. Fixed income has been totally restructured. This gap is something I'll get into a little bit more in depth. For those of you that want to skip ahead to the current outlook, go right ahead. And for the rest of you, I'll give you a little color on what's going on. Here's just a table of 2016 year to date and 2015 for those that want to pause and take a better look. Here we see core equity year to date. And this is the blue line, the S&P is the green line, and then a mixed stock bond portfolio is the purple line. And what happened is in January and February, biotech sold off, I think about 25%. Farm was selling off almost 20%. Healthcare, a big sell-off, double-digit, relatively speaking. And that has really kind of hurt the portfolio. A lot of that came out of the election rhetoric that we're facing. But I think that's short term because all of these sectors that I've mentioned are normally defensive sectors. So, for example, in 2008, biotech went down about 30%, 32% versus the S&P going down over 56% at one point or 55%. So that's what makes it what's known as a defensive sector. So when the market goes down, it typically does not go down as much. Since last summer, biotech at one point had crashed over 50%, more than it went down during the Great Recession. So that tells me that this move is oversold, as they say, that it's a fear-driven move and not something that is likely to last consistently over time. And what supports that is if we now look at core equity after the January, February sell-off, we see it's beginning to do a little bit more what it's supposed to do, which is kind of keep up with the S&P with the same or less risk, possibly even exceed it. There's still a little heavy volatility popping in and out here. We saw some of it in May, and we saw it again during the Brexit situation. Over time, this should mitigate. Historically, again, this is a portfolio that's beat the S&P by about 5% per year since 2007. So before there's changes to the model, I want to kind of sit tight and make sure that it's necessary to do that. I don't think it is. Any questions, anything else, please feel free to get in touch. Moving ahead to market income, again, market income's the blue line, the ACI portfolio. It's doing well. It's doing basically what it's built to do, almost behaving as a mixed stock bond portfolio during sell-offs and recovering sort of along the lines of an equity portfolio like the S&P during recovery phases. So doing good. We're on track this year so far, and hopefully that's how it's going to continue out through the rest of 2016. Full cycle portfolio is doing very well. It's outperforming its benchmarks. Just for reference, MCRO and QAI are hedge fund type benchmarks, and that's really what full cycle is built to compete with, is pensions and hedge funds and things like that that are really designed to try to prosper or at least not lose a huge amount of money during every single economic phase. So we're seeing that that's working out really well so far this year. Durable opportunities, the adjustments that I made in the second half of 2015 took hold. We had a good finish to the year, and as you can see, in the first half of the year during the sell-off, it held up better than the Dow Jones Industrials, and then when that sell-off went away, it began to accelerate up. And then when we got a little bit of a pullback again, this is where I began buying some of the Apple and so on, and between maybe March and here, and I also bought some in February. And then all the bad news about Apple hit, so we're seeing a little more volatility here than I like, but I'm very happy with the Apple position we bought, so we'll see how that works out over time. Here's market momentum. Again, that's the blue line, and we're doing fine here. Got a little more volatility here, and that's because I took the hedges off because I thought that this volatility would be somewhat short-lived, and indeed that's kind of what turned out to happen. It came down and then it ripped right back up. The Brexit took a lot of people by surprise in terms of that it actually happened, me among them, or I might have hedged. But we're also seeing the recovery that I said is likely to occur. I think we're going to get a pullback, over the next few weeks, and we'll see where that goes. But so far, I'm reasonably happy with the performance of this portfolio. And lastly, fixed income. I think those of you that normally follow these videos recall I said it had to be restructured. So right here where you see this thing flatline, it all moved to cash. And since then the model's been restructured, and what you can see is right here the fixed income model, believe it or not, has done 13.3% year to date, which is really on the back of the incredible rally in bond markets. I haven't put any cash in because I just feel bond markets right now are just, there's too much froth in them. It's not a great time to buy bonds. So holding off on that, but I've got a model that looks like it's going to perform well moving into the future if we can get some good buy points. Now, current outlook, rising possibility of recession, same as first quarter, no signal yet. The bond markets are both signaling and featuring rising risks. So there's a relationship between the bond markets and recessions and stock markets and things like that. And historically, when you see this kind of behavior in bonds, it means a recession is imminent, or that there is a very significant amount of deflation in the world that is coming. Not seeing that yet outside of the bond market. As a result, buying bonds right now also features rising risks. There's not a ton of upside in bonds left over the long term, and paradoxically there's a tremendous amount of potential downside if you're buying bonds now and you don't intend to hold them through maturity. So it's an interesting kind of phenomena that we're seeing right now. Consumer spending tailwinds from lower oil prices appear to be hitting the markets. They're supporting discretionary spending in the United States, supporting staples, tech spending, things like that. And for those of you that watch these things, you know that was a theme that I discussed beginning last year, expecting some tailwinds from lower energy prices. The Fed appears interested in supporting both economic stability and market stability. I think that's a good thing. I won't get into the reasons that I believe that's happening, but I think most of us can agree that that's the de facto outcome. Oil prices, to me, seem likely to fall again. There are some oil restraints in terms of supply restraints currently in the market that these various producers are working through. I think once they manage to do that, that we're going to see supply again swell a little bit. I don't think we're going to see $24, $25 oil by any means, but I would expect some kind of pullback with oil moving into the second half at some point. That being said, I don't see oil spending a tremendous amount of time below $40 a barrel or maybe $35 a barrel. I don't see it spending a lot of time above maybe $55 or $60 a barrel for the next couple of years. So that's going to help the U.S. consumer. It's probably going to hurt energy company earnings. I would kind of consider that a wash. The economy still, I think, is going to strengthen a little bit in the second half, but we may see some of that growing strength offset by the Brexit effects, including within the financial sector. I think there's going to be some knockoff in U.S. banks with some lower earnings for a little bit longer than we were expecting, and also I think the Fed's going to keep rates lower for longer. So, we're stuck with lower rates for longer. We're stuck with lower growth for a longer, lower growth environment. So, I think most of the gains we're going to see in 2016, and I hope I'm wrong, but I think they're going to come from things like dividends, strategies like market income, equity builder, which is putting on hedges sometimes on positions to take advantage of volatility. And I don't know what's going to happen with our presidential election. Normally it's a little easier to figure out, what the markets are going to say about something. I just don't see that as the case this time around. I don't really believe either candidate is going to be able to crash the economy. In terms of status quo, Clinton might be a little easier for markets to take in the short term. In the long term, I just don't know. So I'm open to your ideas if anybody's got them. And that's about it. So any questions, please visit the site or shoot me an email. If you're a client, just give a call. I'm happy to talk with you about anything that we covered in here. And otherwise, thank you very much for your time. I'm going to now cue in the theme music again and go through all the tons of disclosures that I have to go through. Sorry it took so long to get to this point. Just a lot of information to cover. Thanks.